We're turning to the car industry now because the US and Europe have been going after China recently for unfairly propping up its electric car industry. In fact, the European Commission's anti-subsidy investigation is wrapping up in the coming weeks and some sort of response is expected from Brussels. But with annual sales of electric vehicles already above 30% of all cars in China, the mood there remains optimistic, as our correspondent Stephen MacDonald saw at the Beijing Auto Show.
Surge, innovation, and momentum are good things coming to NIO this 2024. As one of the standout names in the electric vehicle sector, NIO has caught the eye of investors, particularly with a 15% rise in stock prices this last quarter. Today, we're diving into why enthusiasm is spiking for Chinese tech and EV companies like NIO. What's driving this surge? Will this be the year NIO takes the lead in the EV race? Let's find out.
Until recently, the idea that electric vehicles would make up a significant portion of all cars on our streets was something for the future. Then China came along and thrust the future upon us now. It's achieved this with breakneck growth in the industry, fueled by government subsidies. The problem with this is that the Europeans and Americans are saying that that's given Chinese brands an unfair advantage on price, that they've been able to flood markets in other countries at rates that local brands can't compete with.
China recently found itself at the center of scrutiny as the US and Europe accuse it of unfairly boosting its electric vehicle industry. These allegations stem from substantial government subsidies that have propelled Chinese EV brands into international markets at prices hard for local companies to match. With the European Commission nearing the end of its anti-subsidy investigation, a significant ruling from Brussels is anticipated soon. Despite these tensions, optimism thrives within China, where EVs now constitute over 30% of all new car sales. This surge in electric mobility was evident at the Beijing Auto Show, where the latest innovations in EV technology were on full display. Initially, EVs seemed a distant future prospect. However, China's aggressive growth strategies have made them a present reality. This rapid expansion has been largely fueled by governmental financial support to accelerate the adoption of clean energy vehicles. Critics from the West argue that these subsidies have allowed Chinese EV makers to undercut international prices, thus distorting the market. They claim this makes it tough for non-Chinese manufacturers to compete without similar state support, and they're pushing for tariffs on Chinese-made EVs to even out the playing field. On the flip side, supporters of China's strategy argue that early hefty subsidies were necessary. They believe these incentives were crucial for building the infrastructure needed to make EVs viable, like widespread charging stations. They also argue that without such support, EVs wouldn't have gained the market share necessary to become a sustainable part of the auto industry's future. The mood among potential buyers at the Beijing Auto Show was largely positive. Many visitors preferred electric cars, citing their cost-effectiveness and environmental benefits. The technology on display, from voice-activated controls to advanced screen displays, highlighted how far Chinese EV technology has come. Some charging stations showcased could recharge batteries to support 500 kilometers of driving with just 12 minutes of charging, illustrating significant technological advancements. Moreover, established American and European car makers are now actively competing with new Chinese firms who have invested heavily in EV technology and production capabilities. These companies have constructed large factories, banking on export revenues to recoup their investments. Although fierce competition may lead to some businesses failing, the robust domestic market provides a safety net, expanding as more consumers switch from traditional to electric vehicles.
NIO also presenting its new model, the ET7, which is a sedan that the company claims has a range of 1,000 kilometers, starting price of $59,000 US. And CNBC got a chance to speak with the CEO of NIO and ask him about that increasing competition in the EV market, particularly in China, for a company that started off really marketing at that higher range.
Meanwhile, NIO stock seems to be seeing a notable rise, jumping 8% in just a few trading hours on April 26th. This uptick is part of a broader trend, as its industry peers also experienced substantial gains. BYD's stock has increased by about 4%, and XPeng has surged by nearly 10%. Tech giants like Baidu and Tencent also enjoy gains, although their increases are more modest. This upward movement coincides with a significant surge in Hong Kong's stock market, described by Bloomberg as a world-beating surge. This rally is fueled by improvements in China's economic landscape and optimistic earnings growth projections, which have rejuvenated investor interest in the Chinese market. After years of lagging, the Hong Kong stock market is now riding a wave of renewed vigor, attracting global funds looking for value as other markets, like the US, face steep valuations from sustained rallies. For NIO, this market rebound is particularly timely. Despite facing tough economic challenges recently, the company has held its ground, supported by strong delivery statistics that underline its robust performance. These figures demonstrate resilience and validate many Wall Street analysts' positive outlook toward NIO, alongside other Chinese EV makers like BYD and Li Auto. The broader optimism in the Chinese stock market could boost NIO's stock to climb above the crucial $5 mark. Additionally, NIO is making strategic moves to strengthen its position further. A recent announcement of a partnership with SAIC General Motors Corporation will allow more vehicles to access NIO's charging network, potentially increasing its service revenue and market penetration. The sentiment among these major investors is clearly mixed, but skews towards bearishness. 40% still hold a bullish view, yet a dominant 50% have taken a bearish stance. This division among investors is something to keep an eye on, as it could indicate shifting perspectives on NIO's market stability and future growth potential. In terms of price targets, the activity suggests these investors see NIO's stock price potentially moving within a wide range, from as low as $2 to as high as $25 in the coming 3 months. Such a broad range indicates uncertainty and different company performance expectations. Turning to the technical aspects, examining the volume and open interest of these options gives further insight. This data is crucial as it helps gauge the liquidity and investor interest in various price points for NIO stock. Over the past month, there's been noticeable activity within the strike price range of $2 to $25, signaling that these levels are key for traders. NIO has recently seen a mixed bag of analyst ratings regarding professional assessments. Over the past month, 2 industry analysts have revised their views, with an average price target now sitting at $4.50. Barclays has downgraded NIO to underweight with a target of $4, while Macquarie adjusted their rating to neutral with a target of $5. But before we move on, we just want to thank you for watching this far. Innovation, expansion, and risks. Furthermore, Okoff Investments believes it's not over for NIO, despite the stock hitting new lows. Since Okoff's initial buy rating on NIO, the company's stock has plummeted by 31%, a stark contrast to the 9% rise in the S&P 500 during the same period. This decline was largely due to an unexpected decrease in sales forecasts, driven by fierce competition in the electric vehicle market. NIO's performance in the fourth quarter of 2023 demonstrated a solid increase in deliveries, which went up by 25% year-over-year, hitting 50,045 premium smart EVs. For the entire year, NIO delivered 160,038 units, surpassing their earlier projections and showing a 30.7% increase from 2022. Despite these positive delivery numbers, NIO's stock suffered due to revised sales guidance and profitability concerns. In early 2024, NIO's management remains optimistic, expecting a bounce back with projected deliveries of 32,000 units in the first quarter alone. They also highlighted the upcoming launch of the ET9, a high-end model priced at approximately $111,210. Featuring innovative technologies such as an in-house developed autonomous driving chip and a sophisticated suspension system. The company is also expanding its infrastructure, planning to add 1,000 new battery swap stations and 20,000 chargers by the end of 2024. However, despite these ambitious expansions and innovations, NIO's financial health has been shaky. The company's vehicle margin improved from 6.8% in the previous year to 11.9% in the fourth quarter of 2023, yet it still lags behind the figures from 2021. Revenue growth was modest at 6.5% year-over-year and dropped 10.3% quarter-over-quarter. Furthermore, operational losses and net losses have increased, signaling that the path to profitability might be longer and more arduous than anticipated. On a positive note, NIO maintains a strong cash position with approximately $7 billion in cash and equivalents, bolstered by strategic investments from entities like CYVN Holdings. This financial cushion should support continued investments in technology and infrastructure over the next few years, which are crucial for NIO's growth strategy. NIO's move to introduce a second brand targeted at the mass market later this year, with the first product expected in the third quarter, suggests a strategic pivot to boost sales volume and overall market presence. The company aims to deliver around 200,000 units in 2024, indicating a 25% increase in production, focusing on profitability for its premium products while pushing volume in the mass market. However, investors should be cautious. The risks include a potential continued slowdown in sales growth and the possibility of not achieving the needed improvements in margins amidst fierce competition. High operational expenses, which currently outstrip gross profits, may force the company to seek additional capital, risking stock dilution. So, with all that's happening in the world of electric vehicles and the noteworthy developments at companies like NIO, it's worth pondering the future of this industry. As Chinese companies continue to innovate and expand their presence in the global market, the role of EVs is set to grow exponentially. Stay tuned to the channel for regular updates and in-depth analyses on the tech and EV markets to stay ahead of the curve. Are you ready to embrace the electric future with NIO? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about NIO and NIO stock, just click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.